Today is Wednesday, December 16th, 2020. I'm your host, Max Gottlich, and we talk about my interpretations and insights on financial markets and the overall economy. Manhattan apartment rents have fallen to the lowest point in a decade, and the 70,000 New Yorkers that actually left the city equates to $34 billion in lost income. And the S&P 500 made 30 new highs this year and counting, right? They're probably going to make even more highs. The Vanguard Total Stock Market Index Fund, some of you may have heard, is the first ever indexed investment to actually exceed $1 trillion. And people are borrowing from their home equity for general spending and paying bills, and evictions are estimated to be in the tens of millions. Of course, Bitcoin surpasses a huge threshold today. And it's up 180, 200% this year, right? So, but as we know, valuations and internals matter, especially when both of which become unfavorable. And the vaccines are getting distributed as, pretty much as we speak, and policymakers are printing the checks. So what could go wrong at this point? I'll tell you what could go wrong and what will go wrong. Does a liquidity crisis sound familiar? Or how about a sovereign debt crisis? Of course, today was Fed Day, the last Fed Day of 2020, as Powell took the stand one last time, before 2021. And he begged for, once again, for Congress to push stimulus as soon as possible. Clearly, he doesn't understand large debt and deficits is a huge problem, but real interest rates are pretty much at the lower bound because the Fed, they monetize the debt and they keep interest rates artificially low. That's what they've been doing. Powell knows the Fed is powerless when the economy essentially just goes under. And as we have seen and talked about from previous videos, the printing press only benefits the 1% of the 1% of the world, or excuse me, of America. And basically the rest gets demolished by inflation. And so the Fed is going to have to print fake money forever, just like Japan has been doing much longer than we have, which in turn widens the gap between the 28 million hungry American adults and, the super rich billionaires that are going to become trillionaires, some of which already are. And speaking of wealth gaps, 8 million Americans are descending into poverty, and the actual poverty rate in the United States surged from, I believe, just a little bit over 9% in June, and just this past month in November, it's just under 12%. So clearly, and also before I forget, after Bitcoin surged over 21,000, a catalyst came out from Scott Minerd from Guggenheim. Everyone knows Guggenheim, saying that Bitcoin should be worth $400,000 per Bitcoin. I'll let you do the thinking for that one, right? And let's just say sell the hype or being contrarian is probably the most safest and most discouraging trade of all time because everyone's against you. But aggressive buyers will eventually become aggressive sellers. That's how market cycles work. That's how business and economic cycles and credit cycles work, unless they're manipulated by the Fed, which we're going to get into. So if we check out, if we move on here to the next slide, like I said at the end of the previous video, I wanted to go into depth on the national savings and investment identity. And basically, you should be able to understand how a sovereign's level of domestic saving and investment determines their balance of trade. It's more or less a trade-off between the trade balances and international flows of savings and investment. And this, of course, does not really include the widely unknown shadow banking system comprised of the Eurodollar marketplace, right? So a sovereign like the US has the largest trade deficit in the world by far. Um, and this means that money from abroad enters the country, which apparently is part of the supply of capital. And so the demand for this capital is actually represented by businesses, primarily businesses that need to borrow money. The key word there is borrowing to finance a variety of investments, operation, whatever it is. And although the budget deficit has not been growing nearly as fast a rate as the trade deficit in the US, it's still very important to note that when a budget deficit is present, when it's happening right now, the Fed borrows money by selling. They ultimately sell the treasuries, primarily, which in turn enables the businesses and the Fed to borrow from that supply of savings. So as you can see already, it's a very simple trade-off between the supply and demand of capital. And this takes us to this algebraic formula that you should see on the slide. Very, very simple kind of arithmetic. So if we take a look at this formula between the supply of capital and the demand for capital, you see that the supply side of the equation, it simply states that savings plus the trade deficit, which obviously is calculated by, subtracting imports and exports, in turn equates to that supply of capital. And on the other side of the equation, and to get the demand of capital, you simply take private investments plus government borrowing for what they spend on minus the taxes they collected. So this will yield you the demand side of capital. In essence, this algebraic equation states that quantity supplied of capital must be equal to the quantity demanded. It has to be equal because it's a trade-off. And we already know the US government has been spending more than it collects in taxes, for a good 50 years now, since the 70s. Right? So other countries are literally yielding the US their savings since we don't know how to save. We have no idea how to save. And declining net national savings as a percentage of GDP means investment will also decline. And going back to World War II, we actually saw huge budget deficits, but it was offset by an increase in net national savings. So this relates to the formula. This all determines the sovereign's balance of trade. And of course, we can rearrange this formula to, any scenario we want. That's the beauty of it. And I hope you learned also that we never mentioned QE once here, which ultimately proves quantitative easing really has nothing to do with real economic growth and decline. So with that being said, folks, I appreciate you listening in and wrote down that formula and understood it, as it's the key to our economic balances and imbalances of trade. So I thank you for watching, and you got to note that I'm not a financial advisor, and everything I say is for educational purposes only. All right, so thank you and happy holidays.